Let's break it down. Alright, so you've heard the word trading thrown around everywhere. Maybe you saw it on YouTube or a friend mentioned making money with stocks. It sounds complicated, right? But let's smash that myth right now. At its core, trading is just buying and selling things to try and make a profit. That's it. Think of it like this. You buy a rare Pokemon card for $10 a few months later, everyone wants that card, and you sell it for $30. You just made a $20 profit. Trading stocks. Cryptocurrencies, other assets. You're just doing it with digital assets on a computer or your phone. The whole game is about timing and prediction. You are essentially making an educated guess that the price of something will change. If you think the price of a company's stock, let's say Tesla, is going to increase, you buy it. This is called going long. Then you wait. If you're right and the price goes up, you can sell it and pocket the difference. Now, it's crucial to understand the difference between trading and investing. For now, as a beginner, just focus on the simple buy low, sell high strategy. It's the foundation of everything and where everyone, including me, started. Okay, so you're ready to dip your toes into the trading world. Fantastic. But before you jump in and start clicking buttons, let's pause. Rushing is the fastest way to lose money. Instead, you need a plan. The very first step is to build a solid foundation of knowledge. Don't just watch one video and think you're an expert. Spend some time learning the absolute basics. The second, and arguably most important step, is figuring out your finances. Specifically, you need to determine how much money you are willing to risk. This is your risk capital. I cannot stress this enough. This must be money you are completely 100% okay with losing. Do not use your rent money, your emergency fund, money you need for next month's bills. Start with a small amount. Maybe it's $500. Maybe it's $100. The amount doesn't matter as much as the principle behind it. This protects you from financial disaster while you're in the learning phase. Once you have your educational base and your risk capital set aside, the third step is to define your goals. Are you trying to generate a little extra side income? Are you just curious and want to learn a new skill? Or are you dreaming of quitting your job? Let's slow down on that one for now. Your goals will influence the types of trades you make and the amount of time you dedicate to trading. Be realistic. Your initial goal should simply be to learn and not lose your starting capital. Finally, you need to open a brokerage account. This is the platform that will connect you to the stock market. Once your account is approved and funded with your designated risk capital, you are officially ready to start looking for your first trade. Choosing a trading platform, or a broker, is a huge decision. This is your main tool, like a carpenter choosing a hammer. You want one that's reliable. You want one that's easy to use. You want one that doesn't cost you a fortune. For beginners, the most important factor is simplicity. You don't need a super complex platform with a million indicators and charts that look like a space shuttle's control panel. You need something clean, intuitive, not overwhelming. Fidelity, Charles Schwab, Robinhood, Webull, simple buy and sell buttons, clear portfolio views. The next thing you absolutely have to look at is the fees. Back in the day, you had to pay a commission, maybe $7 or $10, for every single trade you made. That adds up incredibly fast and eats away at your profits. Thankfully, we're in the golden age of commission-free trading. Most major online brokers in the United States now offer $0 commissions on stock trades. Make sure the broker you choose has this feature, but be aware of other potential fees. Another critical factor is the range of assets they offer. Apple, Amazon. Most basic brokers will cover that. ETFs, exchange-traded funds, options, cryptocurrency. Fidelity is fantastic for stocks and ETFs, but if you want to trade crypto, you might need a different platform like Coinbase or a broker that has integrated crypto trading. For a beginner, starting with just stocks and ETFs is the smartest move, so ensure your chosen broker has a wide selection of those. Finally, consider the educational resources and tools the platform provides. Some platforms also offer a paper trading, virtual trading feature. This is an incredible tool that lets you trade with fake money in a real market simulation. All right, the moment of truth. You've done your homework, you've funded your account, now you're staring at the trade button. It's exciting, but let's walk through this slowly and carefully. The goal of your first trade isn't to hit a home run, it's just to get on base and understand the process. Let's use a simple hypothetical example. You've been watching the coffee industry, you believe Starbucks, ticker SBUCKS, is a solid company, and you think its stock might go up in the short term. You've looked at its chart, read some recent news, and you've decided to make it your first trade. First, you'll log into your brokerage account. Use the search bar to look up Starbucks or its ticker SBUCKS. This takes you to the stock's main page where you see its current price, a chart of its price history, and other key details. You'll see two big buttons: buy, sell. Since you think the price will go up, you click buy. That opens an order ticket. This is where you tell the broker what you want to do. It might look intimidating at first, but it's just a simple form with a few options. On the order ticket, you need to specify order type and quantity. For your first trade, use a market order. Market order means buy immediately at the best available price. Next, set the quantity. You can buy a certain number of shares or buy a specific dollar amount. Let's say you decide to buy $100 worth. Enter $100 into the quantity field, select market order, and review everything one last time. Does it say buy SBUCKS? Is the amount correct? If everything looks good, take a deep breath and click confirm or submit order. And that's it. Congratulations, you just made your first trade. Your order will execute within seconds, and you are now officially a shareholder of Starbucks. Now that you've made a trade, the real work begins. It's incredibly easy to get caught up in the excitement and make emotional decisions. This is the biggest mistake beginners make. They see their stock go up a little. They get greedy, or it drops a little. They panic sell. This is called emotional trading, a portfolio killer. The smart move is to have a plan before you even buy. Decide ahead of time at what price you will sell for a profit, your take profit level. And more importantly, at what price you'll sell to cut your losses, your stop loss level. Another massive mistake is what's known as revenge trading. Let's say your Starbucks trade didn't go as planned and you lost $10. You feel frustrated and angry, and you want to make that money back immediately. So you jump into another random trade without any research. That almost never works. It's like chasing losses at a casino. Instead, when you have a losing trade, the best thing you can do is step away. Analyze what went wrong. Misread the chart? Missed bad news? Treat every loss as a learning opportunity, a tuition fee you paid to the market. It's also crucial to avoid putting all your eggs in one basket. Even if you're convinced it's the next big thing, never ever put all your capital into one position. This is called a lack of diversification, and it's incredibly risky. One bad announcement could wipe out your portfolio. Spread your small capital across a few different stocks in different industries. Finally, a very common pitfall is overtrading. Commission-free apps make it tempting to buy and sell constantly throughout the day. More trades doesn't mean more profit. It means more chances to be wrong. Focus on quality over quantity. Find 1 or 2 well-researched trade setups per week, not 20 different trades per day. Be patient. Sometimes the smartest trade is no trade at all. Section 6. The long game, staying safe and always learning. Trading isn't a get-rich-quick scheme. I'm sorry to burst that bubble, but anyone who tells you it is probably trying to sell you something. Think of trading as a long-term skill you're developing, like learning to play the guitar or a new language. You won't be a rock star overnight. The key to longevity in this game is continuous learning and disciplined risk management. Your first goal should be survival, protecting your capital. Your second goal should be consistency, and only after that should your goal be profitability. This mindset will keep you grounded and prevent you from taking foolish risks. To stay safe, you must practice good digital hygiene. Use a strong, unique password for your brokerage account and enable two-factor authentication, or 2FA. This adds a crucial layer of security that requires a code from your phone to log in. Be extremely wary of hot stock tips you see on social media or in random online forums. Most of these are scams designed to get you to buy a stock so the person promoting it can sell theirs at a higher price, a scheme known as a pump and dump. Always do your own research. Trust your own analysis, not a stranger's hype on the internet. Your money is your responsibility. The journey of learning never ends. The markets are constantly changing, and you need to adapt to stay ahead. Dedicate a small amount of time each week to education. Watch videos from reputable finance creators. Read books on trading psychology, and follow financial news from reliable sources like Bloomberg or the Wall Street Journal. The more you learn, the more confident you'll become in your decisions. Keep a trading journal where you log every trade you make. Write down why you entered the trade, what your plan was, and what the outcome was. This journal will become your personal textbook, highlighting your strengths and weaknesses. Ultimately, trade wisely, stay humble. The market has a way of humbling everyone, from beginners to seasoned professionals. Celebrate your wins, but more importantly, learn from your losses. Remember to keep your trading account separate from your long-term investments. Continue to dollar-cost average into your retirement accounts like a Roth IRA, regardless of what you're doing with your short-term trading portfolio. Trading can be a fascinating and potentially profitable side hustle, but it should complement, not replace, a sound long-term financial plan. Start small, stay smart, and never stop learning. That's the real secret to success.